Welcome, everybody. My name is Fabio Petti. I'm a Deputy Head of Group Investment Strategy. I'm here with our Chief Economist, Marco Valli, and Alessandro Caviglia, our Chief Investment Officer for Italy. We just closed our fourth quarter Group Investment Committee, where we depicted a little bit the macroeconomic scenario we expect from 2026 and the relative investment decision that we're going to take for our investments. So Marco, I will start with the macroeconomic scenario and particularly focus on US. We have seen in the last period, and we expect inflation rate to hover around 3%, and yet the Federal Reserve is on a cutting rate path, and the market is even expecting 3 to 4 cuts from now to 2026. How shall we read this pattern?
Yes, Fabio, you are right. Inflation in the US is quite sticky, around 3%. In our forecast, it's more likely that it accelerates above 3% than converging back to the Fed's 2% target. Still, the Fed is on a easing trajectory. The reason is very simple. The Fed doesn't have simply an inflation mandate, but they also have a mandate in terms of maximum employment. And what they currently see is that employment growth is clearly slowing down. Now, there are both the demand and supply factors driving this slower growth of employment. On the demand side, obviously, companies are facing high uncertainty, and that's not helping. But there is also a strong AI-related CapEx cycle ongoing. And this obviously is making companies hesitant and reluctant to hire new people, despite the solid pace of investment. At the same time, we have also factors on the supply side, and that is mainly related to tighter immigration rules. So reflecting this, the unemployment rate is rising, but it's not rising much. And in our baseline scenario, it will continue to rise in 26, but only moderately. And therefore, the labor market will remain broadly imbalanced. So what are the key things that we expect for next year? Growth, I think, will remain solid. Growth will remain solid means in a neighborhood of 2%, driven by a continuation of the AI-related CapEx cycle, but also by some improvement in more traditional CapEx. And consumption will remain in good shape, although largely driven by the wealthy part of the population that benefits from a strong base, from a strong wealth effect. Fiscal policy will be very supportive, particularly at the beginning of next year. The One Big Beautiful Bill will provide fuel both to investment and consumption. So if this scenario holds and the growth will be around 2%, I think that the labor market will not deteriorate meaningfully next year. It will not be great, meaning that if you expand CapEx in AI, you tend to hire less. That's a given, I think. But I think also other sectors will be well supported. So my view is that the labor market will hold. And if that's the case, I don't see why the Fed should cut as much as the market is currently predicting. I think it's more likely that we'll see maybe 50 basis points of cuts from current levels, but not as far as the market is currently thinking, unless we assume that there will be heavy political pressure coming from the White House, which is not our baseline scenario. It's a risk, but not a baseline.
Clear. And it's very likely that the fiscal stimulus will continue up until 2026, as they're going to have midterm election in November 26. Alessandro, let's read the market. And 2 questions for you. On the fixed income side, Marco just depicted a world with inflation around 3%, deficit over GDP close to 7% for 2025 and close to 8% in 2026. So question for you is the market overly optimistic? Where do you see the term premium and potentially what is the stance we have on the US Treasury? On the other hand, on the equity side, we saw massive positive performance on the US equity market despite Liberation Day. As a result of this, currently Mag 7 has a very sizable amount of the overall S&P 500, even above 30%. So people is questioning now, is the concentration risk too high? Are we triggering a potential bubble? What is our reply on these 2 questions?
On the fixed income side in the US, we maintain our cautious stance, meaning we are underweight on US government bonds because the market is pricing too many rate cuts by the Fed and by the expansionary fiscal policy. And we think, yes, the term premium on the long end side, so on the 10 years, on the 30 years, should increase. Currently, investors are quite complacent on this side, because basically what we are experiencing is that in the Western world, in the developed countries, we have high level of deficit, we have an increasing level of debt, we have an increasing issuance. So basically, it's a general movement, so there is no negative stress on a specific country. Coming to the equity markets, we maintain our constructive bias, and we do not think we are in a bubble. Basically, investors are focusing on the high valuation on the overall equity markets, and especially on technology. But reasons for these high valuations are basically two in our mind. The first is structurally, technology sector has a higher price earning multiple, higher valuation than traditional sectors, because investors pay a premium to invest in those companies that has higher growth rate and will reshape not only the economic and financial environment, but the way we live, our future. And the second reason is that those specific companies basically are operating under a quasi-monopolistic environment. Do they will operate in this way also in 3 years from now? Probably not, but this will not happen tomorrow. That is why we say we have to continue to invest in US technology, but beware of the concentration, and so build a portfolio within the technology portfolio.
And this we will cover also later on through the emerging market topic. But before we move that, let me ask Marco, what should we expect on the Eurozone? Usually we have less growth than US and very tilted and driven by the fiscal stimulus. What should we expect, and when do you think we will see the materialization of the German bazooka?
Yeah, I mean, the growth rate in the Eurozone next year is going to be around 1%, while in the US we have 2%, right? The first part of the year, I think we still see some weakness related to the US tariffs. So I don't expect the growth to be particularly meaningful in the first part of 26. But I do expect a reacceleration, gradual, but it will happen, I think, in the second half. That's when we think the German bazooka will start kicking in. It just takes time, right, for a new project to be implemented, because also you have a lot of supply side bottlenecks. So it will not be in the very short term. Think of the German bazooka as a sort of multi-year plan, which will deploy resources over a long period of time. The impact on GDP will start next year, slowly, and then will build gradually 27 and even more maybe in 28, right? So it's a sort of a medium-term project. Besides the German bazooka, we still have in 2026 NGU, which is expected to be strong support, particularly in countries like Germany, like Spain and Italy. And in general, we are in an environment where I think private consumption will not grow particularly strongly for mainly two reasons. One is that the labor market is softening. And the second is households continue to increase their precautionary savings, and consumer confidence is still stuck at low levels. So I don't have great expectation about a strong consumption recovery. Consumption will grow, but it will go broadly in line with overall GDP. And importantly, the trajectory will be one of acceleration moving into second half of 26 and even more in 27. On the inflation side, in the Eurozone, I'm very relaxed. Pipeline pressure is either weak or weakening. Wage growth is slowing down. Core inflation in my forecast drops below 2% next year. And headline inflation averages slightly below 2%, both in 26 and 27. Monetary policy, I think, is in a good place. There is still some residual risk that the ECB might cut once more, maybe over the next 3 to 6 months. And I think it's a risk that is becoming smaller. So the baseline remains that the ECB is done cutting interest rates, and the deposit rate will remain at 2% throughout 2026.
Okay, thank you, Marco. Alessandro, the reading on the market for the Eurozone. Marco just depicted a growth around 1% and ECB to stand still around 2%. Default rate are at the very low level on the credit side. What is then our stance on the European government bond and on the credit market for fixed income? And looking at equity, which kind of sector will we bet on?
Well, on the government side, we share more or less the same worry we have for the treasuries. So we are not advising to invest in the long end of the curve because, especially in Germany, we will have fiscal policy expansion and increased issuance. So basically, we will continue to focus on the intermediate part of the curve, building portfolio with an average duration of 4-5 years. But basically, the bulk of our portfolio is euro-denominated corporate bond investment grade. It's true that spreads have compressed a lot during last years, but we think that in terms of total yield, we can have a good and interesting carry from that component. Obviously, the overall potential return of the fixed income component is not that interesting because it will be lower probably than 2025, but we see no specific risk. We think, it will be a year of limited carry and a potential return that could be around 2-3%.
And on the equity side, which kind of sector you see?
On the equity side, basically, we are focusing on industrial. Basically, we think that the economic theme is, let's say, the German Renaissance. And so in this way, we think that the industrial companies in Europe can perform better than average. And we are adding also exposure to the high dividend strategy, which is not a sector, it's more a factor, a theme. But basically, with such low level of short-term rates, we think that investor will seek opportunities in those companies that have a higher level of cash flow and dividends than average.
Okay, thank you, Alessandro. Let's use the last couple of minutes, Marco, to cover with you the third big area we discussed in today's Group Investment Committee, that is China. What are your expectations on the overall economy per se? And then if you give us some guidance on what is your view on the technological side that we may see out of them.
Yeah, we remain cautious on the broader macro story in China. Growth, I think, is going to slow down in 26, and we are not seeing a turnaround in real estate, in consumer spending and consumer confidence. So on that point of view, we remain cautious. But I do continue to see a strong and politically driven impulse on investment, and particularly when it comes to investment with high technological content. Right, this will remain a key area of focus from a political point of view, and this I think will have important implication for our allocation strategy. The fact that the Chinese government remains committed to stimulate investment, and particularly tech investment, while private consumption is not really a target of government policies, means that China will continue to produce more than what it will actually consume. And this creates overcapacity, and China will continue to be a source of disinflationary impulses worldwide also next year.
Thank you, Marco. So I come to you, Alessandro. One of the things that we discussed and we decided in the Group Investment Committee is to extend the perimeter of our investable assets. And so on the fixed income side, we confirm basically our positive stance on that side. And on the equity, we are opening the possibility to broader extend the technological bet we are having toward that market. Can you give us some guidance on this?
Yes, overall, we maintain a a constructive stance towards equity and towards global equity portfolio. So basically, when we build a portfolio, we invest in US, in Europe, and emerging markets. What we are going to do is to increase our exposure to emerging market equities. And in this way, we will pursue several objectives. First of all, since when we talk about emerging market equities, 60-70% is Asia, and the main sector is technology, this is a way we have to diversify our exposure away from US technology and investing exactly in Asian technology stocks. Secondly, we are investing also in those economies that in a geopolitical world which is in transition will have higher influence, not only in terms of economic terms, but also financially and from a currency perspective. And in fact, what we think is that since the US dollar is on a, let's say, prolonged period of devaluation, probably the Asian currency will benefit from this devaluation. We see strong return opportunities in Asian currencies.
Good. I think we are running out of time. I thank you, Alessandro. Thanks, Marco, for this, and see you on to the next one.